Do you see my screen? Can you please write on the chat box if you see my screen? Okay, great. All right. Thank you. So we start now. So today's topic is position sizing, and it is as important as entry and exit in your trades. So there are three components to trading: entry, exit, and money management. So position sizing is a part of the money management. So no matter how great your entry and exits are, but if you don't have a proper money management or proper position sizing, uh, you will hurt in trading. So this concept is very important to understand, and it's a broad topic. I'm just covering for 25 to 30 minutes. So if you interested in learning more, then please do the research and learn more on this topic. Okay. So position sizing is today's topic, and it will run around 25 to 30 minutes. So Lao said, "He who thinks he knows doesn't know. He who knows what he doesn't know knows." Meaning, a lot of traders, when I ask them about the position sizing, they don't want to learn. They don't care. They just say, "Oh, well, why do I have to learn? Just give me entry and exit." So, and that's it. So they have no idea about this topic, and that's why they cannot make it in trading. That's what happened. So, for example, I said today in today's webinar, the topic is position sizing. So the number of attendees today is 1/3 in today's webinar. Then if I had sent the email out, then I am going to give you hot stock tips. So if I had said I have come to this webinar and I will be giving out hot stock tips, there will be 3 times attendees in the webinar. In this webinar, they are 1/3. So this shows that all those who have not taken time to come, they don't understand the topic. Otherwise, they would have come, maybe more. If I just say hot stock tips, Nosh is going to show, and you will make a lot of money. So what the position sizing does, the position sizing tells us, based on our portfolio size, how many shares we need to buy, or how many option contracts we need to buy. And then on top of that, you have to apply a more, based on your own situation, you need to apply more rules based on your the market position, what is going on in the market condition, how many positions you have open in your portfolio, what is your bias towards the market, whether the market is a bullish, bearish, mildly bullish, bearish, or is it choppy, some event coming up in near future that you are aware of, and you should be cutting down on your trade. What is your recent performance in trading? Is it good? Is it bad? Are you having a streaks of winners or a loser, or one winner, one loser? All this goes into your before you put into the put money in the trade, and then on top you have to apply position sizing formula. And there are various formulas for position sizing, so I'm just discussing one. So if you know this one, you have a lot of knowledge than all the other traders who don't know this. And I see this every day, what mistakes traders make, and then they wipe out their account with just 1 or 2 bad trades. So the idea is not to wipe out our account with 1, 2, 3, even 4, 5 bad trades. We stay in the market, and then the market will take care of us. So the position sizing answers question like this: how many shares or options contract per trade? So when you're putting the trade, you need to know, okay, how many shares I'm going to buy now. Is it all the time you will buy 1,000 shares just because you love 1,000 figure, or is it the broker's default setting for 1,000 shares? It doesn't matter if you're buying Amazon 1,000 shares for Amazon, or buying 1,000 shares for a company like AKS steel trading at $5 or $6. So I see that all the time. When I send alert, people respond. I bought 1,000 shares. So it doesn't matter what is the condition or what is the price of the stock. They just buy 1,000 shares or just buy 10 contracts. I buy 10 contracts or I buy 5 contracts. Doesn't matter if it's NVDA or is Morgan Stanley option trading at $1 or NVDA trading at $20. I just buy 5 contracts. So that's what happened. They wipe out their account. So, so another question: controlling your per trade size as a function of risk. So risk of ruin. So what is the risk of ruining your account? So you have to know that what risk I have in ruining my account right now, and what risk I'm taking when I'm putting on this next trade. So risk of ruin is important. So position sizing answers the question. And if you understand position sizing, it will eliminate fear from your trading. And how does it eliminate fear? Because when you're putting the trade, you know where is the target, when you will sell. You know where you will exit if you're wrong. You know how much you will lose in this trade if you're wrong. You also know how much the loss is the percentage of your portfolio. So when you know all this, then the fear goes away because then you are calm. So in trading, you need to be calm all the time. So the traders go through different mental states when uh, the market is open. Some traders are confident. They have a flow because they are expert and they can handle any market condition. So you need to be expert in the market, and depending on even if the market conditions are challenging, you need to be calm because you know what you're doing. Everything flows normal. Sometimes the market condition is challenging, difficult. Your skill level may be low, medium, high. So all this going on in the market. But if you are putting your trade based on the positions, I think you're eliminating fear and eliminating panic. So if the trade is going wrong, if you buy, like, suppose 10 contracts of NVDA, $2,000 per contract, you invested $20,000, and you have a portfolio of, let's say, 40,000, and NVDA goes against you, you're losing. Suppose you put 20,000 and it's a 50% loss, 10,000. So that $10,000 loss is 25% of your portfolio. So then you will panic because you see 25% wipe out. And then you will get out in a hurry because you see a big loss as a percentage of your portfolio. So if you have a $40,000 portfolio, you shouldn't be investing $20,000 in one trade. It should be like $2,000. So if a $2,000 you put in the trade, the same NVDA trade, you're losing only 1,000. So 1,000 compared to 40,000 portfolio is minor. So then you won't panic and then you won't exit. You will stay calm, and you will eliminate a rate of errors. So this is what happened when you bet your bet size. So your bet size is big compared to what you can handle financially and emotionally. So you commit errors. You get out fast. You look for another trade to recover the loss, and then you make another mistake. So all this adds up. So this is not right in trading. Trading, you already have thousands of variables which can go wrong when you're putting the trade. One miss, you forgot to check earning. Let's say out of 10 variables you check before put the trade, and you forgot to check the earning, and you put a big bet size which you can handle. That error can cost 100% wipeout in your in that trade. So eliminate errors. So once you follow the position sizing formula, you build confidence and you are building discipline. So discipline is so important in trading, and we all know. very important in trading. And so by being disciplined, we every day whenever we put the trade, we are ready. We know the portfolio size we have, we know how many positions we have open, we know the market condition. So when I'm putting the trade, I'm constantly watching the market condition on one of the screens. I'm just seeing what's going on, and what's going on with my open position, and what is my portfolio balance, and then setting the trade. And then I have faith in trade because I did the best. I entered correctly based on my knowledge. I know where I will exit based on my knowledge, both on the loss side and on the gain side. I know how much I'm going to lose. So I have faith in the trade, and I stand firm on my conviction that the trade will work out. And even if the trade's not working out, bad trades coming up one after the other, like one, two, three, four, I put the trade, five trades, and out of five, four are loser. I'm still surviving in the market. I'll cut down my trading. Uh, when you start losing, you can say to yourself, okay, if I lose in the trade, I will cut down my exposure to half in the next trade. So if I invest $1,000 and I put the trade, and that trade was a loser, I will put only 500 in the trade till my winning streaks come back. And if I lose again, I'll cut down further $400. And then when I start winning, I'll just raise my exposure per trade. Maybe I'll from 500, my formula says I'll double to 1,000. But 1,000 is still within the position sizing range. And then finally, what happened, you eliminate bankruptcy in trading. So that's what happened to traders. They bankrupt themselves fast within few trades. Your If you follow proper position sizing and you're managing it properly, even if you doesn't matter, few bad trades or consecutive 6, 7, you should not be wiping out your account. And the last thing is the portfolio. The capital plays the role in trading. So a lot of traders don't have sufficient capital. They come with $2,000, $3,000 trading. That's not enough. So capital is important. Commitment is important. The traders don't have commitment. They just sometimes trade, sometimes don't trade. They monitor the trade, they don't monitor the trade. So all this is they eliminate. They go bankrupt. So now the position sizing, the main thing. So there are three variables of position sizing. One is the portfolio size, and another one is the risk tolerance percentage, and the third one is the stop loss percentage. So out of three variables, two are kind of constant. One is the one which is variable, and you have to you evaluate based on each trade. So portfolio size, let's discuss this portfolio size. So portfolio size is week to week. I mean, you know the balance. So all the open positions and the closed positions, all the open positions plus the balance you have. So you, based on the open positions, the balance you have. So you know your portfolio size, and then you define the risk tolerance percentage. So risk tolerance percentage is how much you're going to lose as a part of the portfolio if you lose in that trade. So is it 2% of the portfolio or 4% of the portfolio? So it could be 1% if you're very conservative. Normally they say it needs to be within 2 to 4% risk tolerance. So if you have $100,000 portfolio, when you're putting on the trade, you shouldn't be losing more than, let's say, $2,000. So if a trader loses $20,000 on one portfolio, then he has a tough job ahead to recover that $20,000 because he just lost 20,000 in one trade. He should be losing only $2,000 or $3,000. So you define your risk percentage in advance: 2%, 3%, 4%, 1%. You know your portfolio size, and then when you find the trade. So when you find the trade, then this is the part where the technical analysis comes. or what you can say, predetermined dollar amount. So some traders have a they just say, I just want to lose, if I lose, I would lose this certain dollar amount. It doesn't matter if the stock has technically violated or not. It's still a good trade, but they say no, I just take this dollar amount. Some traders, they say, um, uh, based on the percentage. So again, it's the same. Some traders, they base their loss on technical analysis. So sometimes, suppose you go long on a trade, and the support, you find the support level. The support level is too far from your entry. So if the support level is too far from your entry, if the trade starts going down, and the support is too far, then you will lose big when the support is violated. If you have an exit rule based on the support, or if the support is very close to your entry, then you will lose less if the support is violated. So that's why they say that technically you should be entering very close to the support. So the reason they say that, in case you are wrong, you are immediately wrong and you lose less. But sometimes the support is far, but the trade looks good and you enter. So you should know how much you will lose when the support is violated. It could be 80% of your option price, or 70%. It could be 50%. So the stop loss percentage varies from trade to trade. So at that time, based on stop loss percentage, that's where the formula, which I will show you, will tell you how much you will invest in the next trade, in this trade. Okay. So this is where the technical part comes, or your own judgment comes per trade to trade, and it varies per trade to trade. So risk tolerance, I discussed risk tolerance, I'm discussing again. So risk tolerance, what is risk tolerance? The second part of the second variable. The first is portfolio size, you know already. The second part of the position sizing is a risk tolerance, how much you are willing to lose as part of your total portfolio amount. So how much is it? 2%, 3%, 4%? You have to decide before you put the trade, or before you even start trading. So it remains constant throughout your trading. Sometimes you will, the thing is this thing, risk tolerance, varies based on the market condition. So if the market condition turns choppy or sideways, something is happening, your risk tolerance should go immediately down, like 1%. Then you say, okay, I'm going to lose only 1% or half percent, no more per trade, because the market condition is not good. Or maybe you should just stop trading if the market is bad. Sometimes the market condition is so bad that you cannot do shorts, you cannot do long trades, because you get killed both sides. The market is so volatile. So the risk tolerance goes immediately down to like 0.5%. And then when the market is green, everything is getting bought, even monkey is making money. That's where you increase your risk tolerance, maybe 4%, 5%, 6%. You say, okay, I'm willing to lose 4 to 6%, because you know that the chances are less. Market conditions is good, is really bullish. Market has given, suppose, a major buy signal, and whatever unknowns were there are known factors, and whatever government policies are is favorable, and the market is moving. So you increase your risk tolerance. At that time, you say, okay, I will bet more, but I will risk more now per trade. And this is where you accelerate, and your portfolio goes up. So anywhere 0.5% to or 0%, you're not trading at all, to 4%, 6%. So this is the risk you define based on the market conditions you have when you're trading. So as part of your total portfolio amount, and you know your portfolio amount every day. So you know that, and then you define the risk tolerance based on the market conditions. Now, stop loss is based on each trade. So Now comes the trade. Market is bullish. Suppose market is bullish, and you say, okay, this is the time I need to make money, and I'm going to risk higher amount. So you are risking 4, 5, 6%, and now you form the trade. Suppose JP Morgan, JPM, and you say, okay, JP Morgan looks good. Financials are moving up. Today, the financial stocks are being bought, so I will buy JPM. So let's say you decide that. So now the technical analysis coming into the trade, and you're figuring it out. Where is the support? Where is I can go wrong technically? First, you need to know where I could go wrong. Then you worry about the profit, where the profit will be, because the profit is unlimited. The stock can go to the moon, and we see that a lot of time we exit from the trade, and then the stock just keeps going up. So the profit can be unlimited. The loss cannot be unlimited, or whatever. Suppose you put $10,000, you can lose all $10,000. So that's the limit you have. So you know the downside risk, $10,000. If you are in that kind of trade, sometimes the loss is unlimited also. So you don't want to be in that situation. So you know what's your loss. So how much are you willing to lose in a given trade? So every time you put a trade, you need to know that. So once you know that, then you can apply the position sizing to your trade. And there are various models. So we will discuss just one model today. The first model is called percent risk model, and the second is percent volatility model. So we discuss percent risk model. So now here is the formula. It's simple formula. I'll give some time to write it down if you want to write it down. And once you understand it, you can do a simple calculation, or just on your calculator or on an Excel worksheet, or mentally. You can even do mentally later once you have a flow or remember the formula. So the formula of position sizing, which is telling you how much you are willing to lose, is portfolio size. So whatever is your portfolio size, divide by the stop loss percentage. So when you're putting the trade, let's say you say, okay, if I lose, I would lose 50%. I'm talking about option trading. So if I lose, I would lose 50% in the trade. So divide that portfolio size by that 50% and multiply risk tolerance. Or you and yeah, multiply by risk tolerance. So let me explain in next slide how you will by putting the numbers, so you would understand. So let me give you example of a portfolio size $50,000, and the market is mildly bullish. So market is mildly bullish, and you say, okay, now I'm going to I'm deciding that if I lose, I would lose only 2% of my portfolio. So what would be that amount based on 2%? So 2% would be $1,000. So now you know, in this trade, suppose JP Morgan, if I lose, I am willing to lose $1,000 because I have $50,000 balance in my account. So if I lose, I will lose $1,000. So you know that $1,000 I will lose. You decided. All right, so this is just a simple formula. You take 50,000, your portfolio size, and multiply by risk tolerance, 2%. The risk amount comes to $1,000. Now, let's take example of Amazon and apply the position sizing. So let's say Amazon and the outlook is bullish. So you assume that the Amazon is going up. And you say, okay, I am willing to lose whatever dollar amount I invest in Amazon. For that dollar amount, I will lose 50% in the, I'm willing to lose. If I lose 50%, I will exit. So that's your percentage. It doesn't matter if it's a predetermined percentage you apply for each trade, or is it because the Amazon is volatile? So you figured, okay, I need to give a margin like 50% margin for loss, because in other trade you put on only 25% loss percentage, but in Amazon you're willing to lose 50%. So it's based on this formula or based on technical. So based on technical, you say, okay, if the stock violates this support level, I will be exiting and my option will be trading 50% of what I pay. So, so you know that, stop loss percentage. It can be, it need not be accurate, like 50% accurate, 50%. Only 50% accurate is if you put the hard stop. You buy, suppose a contract for 10,000 and then you put the stop at 5,000. So that's your hard stop. 50%, but it can vary from 50%. It could be by the time you exit in real life, it could be 55 or 45. So let's assume the price of the call is $20. So if the price of the call is $20, then we know each contract is costing us $2,000 because one contract controls 100 shares. So if one contract controls 100 shares and the price of the call is $20, we will invest $2,000 per contract. So we know that. And we know the stop loss percentage is 50. So how many contracts of Amazon we should buy? That's what we are trying to determine when we are executing the trade. Is if you don't know this, and when the trade comes, we get excited and we just buy what we are not supposed to buy. First of all, we are not supposed to buy Amazon if the portfolio doesn't have at least $50,000. So, so at the time of putting the trade, we need to be calm. We know how much, we know our numbers. So we buy the contracts accordingly. So the formula of position sizing is telling us that based on the risk tolerance of 2%, and we are willing to risk $1,000, the contract price is $2,000. Our stop loss percentage is 50%. So we will be stopping out at when the Amazon is trading at $1,000. So the contracts we will buy one. We can only afford to buy one contract of Amazon, no more than that. So how this one number came? It came through this formula I gave you earlier. So investment amount, portfolio size divided by stop loss percentage, multiplied by risk tolerance. So your portfolio size is 50,000. The stop loss you determine on Amazon 50%. So you divide 50%, 50,000 by 0.5, which comes to 100,000, and 100,000 multiplied by 2% risk is $2,000 amount. So you have you can only invest $2,000 on Amazon based on your criteria. And since Amazon is trading at $2,000 per contract, so you can only afford to buy one contract. If you buy two contracts, then your risk tolerance will go to 4% because you will be willing to lose you're willing to lose 4%. So you can buy two contracts, but you know how much risk you have. So this is what the position sizing is telling you. And once again, the risk tolerance varies from market to market and your own conditions of the winning trades and the losing trade. And the stop loss is based on each trade. Okay. So let me explain this. So let's say you want to increase the risk tolerance. The market is bullish and you have a winning streaks. So now you are willing to risk more in the market. And that's what you should be doing ideally. If the market is really bullish, you need to take advantage of the market and you're willing to risk a higher dollar amount. That's where the portfolio accelerate to the upside. And then when the market condition bad, you cut down. So the previous risk tolerance was 2%. The new risk tolerance is 4%. So let's say you are willing to lose 4%. So now, let's say the portfolio size is $50,000. So your new risk amount is $2,000 per trade. So now you are willing to lose $2,000 per trade out of your $50,000 portfolio. And let's assume keep this variable constant, which is a stop loss. So 50% is constant. You're willing to lose 50% in Amazon trade. So how much dollars you are willing to invest in Amazon. So again, based on the formula, portfolio size is 50,000, stop loss remains constant, 50%, risk tolerance goes up. So in this formula of three variables, you're keeping two constant and one you're changing it. So once you change it, it gives you the amount $4,000. And since Amazon is trading at $2,000 per contract, you can buy now two contracts. So position sizing telling you you can afford two contracts. So just by changing the risk tolerance up and down, it gives you new figure, right? So just by changing the risk tolerance, and risk tolerance is changed based on the market conditions. Now, what if we decrease the stop loss percentage? So what happened? So let's say before, when you're putting the trade on Amazon, you put the trade on Amazon and you figured that, okay, if I lose 50% on a trade. But now you said no, my entry is solid, and if I'm wrong, I will be wrong right away, and I'm willing to lose only 25%. So in that trade, and your risk tolerance is still 2%. So you're being conservative. You are willing to lose $1,000, but your stop loss percentage has decreased from 50% to 25%. So now how many contracts you can buy from Amazon? So investment amount, this is again, the formulas remains the same. Portfolio size divided by stop loss percent, multiply by risk tolerance. So your investment amount based on the formula comes to $4,000. Just because you decrease your percentage figures. So your investment amounts of 4,000. So how many contracts you can buy? Well, you can buy two contracts for Amazon now, but you have to stick to your stop loss percentage of 25%. Anytime you go above 25%, you will lose more than $2,000, more than $1,000, and that will increase your risk tolerance. If you lose 1,500, it goes to 3%. So you have to stick to your stop loss of 25%. So if you lose 25% in the trade, which is $1,000, you will be out. So now you can buy two contracts of Amazon. This is happening dynamically every day. You have to determine the market conditions. You need to determine the stop loss for the trade, and you know your portfolio size. So you can play around with your variables. So we discussed two variables. We changed the risk tolerance from 2% to 4%. We decreased the stop loss in another scenario. We decreased the stop loss from 50% to 25%. Now the third variable, portfolio size. So if your portfolio size is going up, now your portfolio, suppose you started with 50,000 and now your portfolio has doubled and it's 100,000. Now you are willing to in risk more dollar amount because the portfolio has gone up. And if the portfolio is going down, then you have to risk less because the portfolio size is part of the equation. So possible scenarios. I already discussed three scenarios. So these are another scenarios. So let's discuss this. So risk tolerance remains same. Let's say risk tolerance remains same. You define 2%. The stop loss percentage remains same 50%. So let's say in every trade you have a formula that when I lose, I generally lose 50%. So you did your calculations of the past trades. So you are excellent trader and you keep your trading journal and you know how much you make per trade on average and how much you lose. So you said, okay, whenever I lose generally 50%. So you keep that percentage 50%, apply that rule, and your risk tolerance is 2%. So now the only variable changing is the portfolio size. If your portfolio is going up, you will risk more amount. If your portfolio is decreasing, you will risk less amount. So now only the portfolio size is dictating how much you will invest because the other two variables remain constant. The other scenario is the risk tolerance you increase to 4%, and you increase the risk tolerance because market is bullish. So you say this is the time I need to go for it. It's not like you go crazy and 10%, 20% you're risking per trade, because the market can turn south anytime. It doesn't tell us when it will do. So you just instead of 2%, you are risking 4%, not going to 10%. So risk tolerance you increase to 4%. Stop loss remains 50%. You say, okay, on average I lose 50%, so that's my rule. So your trade amount will increase because you're willing to risk 4%. So you change out of 3 variables, you now change one variable, which is 4%. If your portfolio size is going up and the market condition is bullish, let's say, so your trade amount per trade will go even higher because your portfolio is up. You're willing to risk more. And let's say your entry is so great that you said, okay, if I lose, I will lose only 25%. So if your portfolio size is going up, your risk tolerance is going up because of market conditions, and your entry is so good, you are willing to lose only 25%, then your per trade amount will go even higher. But it's in reverse. When if the market condition is bad, you decrease your risk tolerance to 1%, your portfolio is going down, you say, okay, I'm willing to lose, let's say, 100% of the money in the option. So it happens 100% is possible, right? You buy an option for $1, that can go to zero, because the dollar, there is no it's very hard to put the stop loss for an option which is trading at 50 cents or $1. The stock moves slightly against you, and suddenly you see option trading at 5 cents, and there's no bid. So you cannot sell. Even if you sell, it's equivalent to the commission you pay to the broker. So there's no point selling. So you can lose 100% in the trade. So again, so it depends on the options also, right? So when we trade option, we not only the trade is telling us where we will exit, but the option price itself is telling us how much we can lose. So if you buy option at $10, $5 move is a big move. But if you buy an option for like 80 cents, that whole 80 cents can be wiped out. So you should, when you're buying a low price option, people say it's cheap. There's a reason for it's cheap. Should be willing to lose 100%. So when you willing to lose 100% in that trade, your per trade amount should decrease dramatically, because 100% wipe out in that trade. So, but it's okay if you know you will make two times more. So if you put 80 cents, it's going to $1.60 or $2.40. So you're willing to take that risk. And it happens when the major news is about to come, or earning trade, or the stock is so volatile, you bought out of the money calls, etc. So various conditions of putting that trade. So your amount per trade will increase in this scenario. But in the scenario I was telling you about 100%, your amount will go down. So that's where I see the other traders, they just constantly investing same dollar amount. That doesn't matter what is the option price, how much, at what price it option will end up if it goes against you, you or them. So the third scenario is, which I was discussing, risk tolerance remains same, 2%. Stop loss percentage increase to 100%. This word remain is wrong. The stop loss percentage increased to 100%. So now the scenario I was talking is you bought an option for 80 cents. It can go to zero in same day or next day, and then you don't ever see it coming back. So your per trade amount will decrease. So in option trading, there's another, what I'm trying to say is another variable going on is what's the option price itself. Now the fourth scenario, risk tolerance remains same, 2%. Stop loss percentage decreased 25%, which I discussed, that your entry is so tight that you said, okay, I'm only willing to lose 25%. When you put the trade in option, there's a spread, right? We know. So the spread is normally 5%. So as soon as you put the trade, you're losing 5% of your investment. And if the trade goes against, then the percentage goes to 10, 15, 25 right away, the same day. So there's very tight stop. You will be stopping out fast. if you put 25% stop loss on an option trade, it's like stopping out same day, maybe next day, and then you see the trade going in your favor. But if you do 25% stop loss, your per trade amount increases because you're willing to lose less. So now we covered the topic of position sizing and what we learned. So what we learned is this, that we need to start small. So this is another mistakes people do. When you are trading somebody else system, or you are new, either you are new or you have a small portfolio size, or you are trading someone else's system. So you sign up for someone else's newsletter, you don't know what is going on. Maybe you don't understand his trade, or your personality doesn't match his personality. His objective doesn't match your objective. Your trading style doesn't match his trading style. And then if you go big, and then you get frustrated. So you have to start small and see what's going on, and see the market conditions, see what is it, a winning streak, a losing streak, or what's happening. Start small. You can always accelerate later, and avoid risky trades based on your portfolio size. So not all Amazon and Google and PCLN and NVIDIA trade, Baidu are the trade for everybody. So these trades are highly volatile. So you need portfolio size has to be big. So it's not for everybody. And manage losing streaks. So if you apply position size, you can manage the losing streaks, because you know, okay, when to accelerate, when to decelerate, how much to invest. And avoid gambler's fallacy. So gambler fallacy is that when they lose, they double down on the next trade. So if then they double down to recover the loss. That's wrong. So if you invest $1,000 and you have a winning streak, you can go 1,500, because you now know that, okay, the market conditions are good. If you are having a winning streak, it's not you suddenly that you are having a winning streak. Nothing changed in you from last week, this week. It's the market. So we should be very excited and happy that figured out a holy grail. Try to find the reason why you are having a winning streaks. It may not be you. It may be you after you did a lot of research and fine tuning your entry and exit, but probably it's the market. So if it's the market, then the market can take it back. So you have to be on guard all the time. So instead of trading based on a gambler's, the way the gamblers trade, you trade like a robot, systematic discipline. And the one thing is to avoid time-based profit objective. So some traders, they have a time limit that they need to make certain dollar amount by the end of the week. Like suppose, let's say Friday, and today is Thursday, and they haven't met the goal yet. So, and they are way short of meeting their goal. Let's say their goal is to make $1,000 in a week, and they just made only $400. So they are short 600. So because they want to make additional 600 to meet the goal, they commit errors, because they have a time limit set, and they commit error. And when they commit error, the way they are trying to make that 600 is to increase the bet size in the next few trades, because the week is coming. So don't do the time-based profit objective. Is bad. Don't force yourself. Just stick to your position sizing plan day in, day out. Just follow the rules, and your account will take care of itself. It will grow steadily. So and watch your equity curve. So on a weekly basis, suggest that you write down your equity balance in an Excel sheet, ending balance, and if you can plot the equity curve, like just a graph, simple graph on Excel, it should be going up. Ideally, it should be going up smoothly. If it's not going up smoothly, if it is wild, like one dollar amount is way on the graph is way up, and one is way down next day, and something is in the middle the third day. That's very wild equity curve. So if it is a wild equity curve, a lot of things are happening which you need to take care of to make it smooth at a 45-degree angle. So your equity curve should be rising smoothly. It can be rising at 30-degree, but it shouldn't be rising at 90%. Then suddenly in 1 month you made a $50,000 out of a $50,000 portfolio. That's not normal. That's something crazy happened. You got lucky, or market was very good. You should not be excited about it. Rather calm down and say, okay, next, I don't want to give this 50,000 I made by luck. All right, so grow account steadily if you follow the rules. So this is the quote I got from Dr. Barton, and he's talking about a story of a blown up account. So he says that I have talked to many folks who have blown up their accounts. I don't think I have heard one person say that he took a small loss after a small loss until the account went down to zero. Without fail, the story of the blown up account involves inappropriately large position size, or huge price moves, and sometimes a combination of the two. So, what he's saying is that the trader wipe out their account based on because they have a large position size, or the trade went against them tremendously overnight, gap down, gap up, or it's some combination of both. So they put a large bet size, and it so happened that the news came and the trade went against, and that whole trade is wiped out. And if that trade dollar percentage is a big part of their portfolio, then it would be very hard for them to recover because they now lost a big amount. And emotionally, they are not ready to take the next trade, even though it's a no-brainer. They see it, they let it go. It happens all the time. All right, so the last is that I have a 6-month coaching program, which has turned into 7 months, 8 months, based on the coaching program going on right now. If you're interested, send me a mail, this email address, askus@financialmarketwizard.com, and then we can talk for 75 minutes. And then we will go over your trading issues. I will guide you in that session, and I will tell you what this coaching program is about. So you have to sign up. The cost is $97, which is refundable if you join the strategy session. So you don't send the email inquiry about what is the cause and what I teach, etc. I will teach you, or I'm teaching right now, whatever you need to be successful. So I will tell you in detail in this 75-minute session. It takes 75 to 90 minutes to talk and go over, but and I will send you the booking link if you're interested. And if you don't have a swing option service, you can try it out for $287 for the quarter. You can either send me email, or I will send you email. I will send email to only those who are not my swing option member. So if you are already a member, you won't receive this offer. All right. So thank you for coming. And the next webinar will be in 2-3 weeks. I'm traveling. Right now I'm in Thailand, and I'm traveling, but I'm doing everything as I do in America. I trade, I do everything is taken care of, and I travel. So right now I'm traveling. It's early morning here. All right, so see you tonight, which will be your morning time, and good luck. Thank you.